Hi everyone, welcome again to another one of our videos in relation to the last budget. This one is going to be quite a long one, I suspect, because we're going to cover off some of the changes that happened to employers, and obviously there were quite a few.
Yeah, quite a few, quite big changes, really, wasn't there? And they're going to have quite a lot of impact.
Quite, yeah.
And the reason being is because obviously she's trying to fill this hole, and we think that particularly the national insurance change is going to be one of the big things that she can use to fill that gap in the public coffers. So thinking about national insurance, let's get that one out of the way. It's been in a lot of the headlines. What are some of the main changes, particularly with rates, bands, and also the employer allowance?
So I think the first thing to say is obviously it is only employers' national insurance she's changed. I think obviously they were quite set in their manifesto that they weren't going to change taxes and NI for workers. So what she's decided to do is, having discovered this whole taking over from the last administration, is change NI for employers quite dramatically. So from 6th of April 2025, the bands are going from 13.8 to 15%.
Quite a jump.
So that's quite a jump in itself. But tied into that, the point where it starts used to be obviously at 9,100, and that's gone down to 5,000. So that brings yet more people into NI at the higher rate.
So for larger employers, this is quite a real impact for people.
I would imagine people are busy doing some calculations. I think we'll have a calculator that's coming out, if it hasn't already, to help people with this calculation. Because I think if you look at your budgets and your cash flows, certainly if you're looking at next year's pay rises,
which ironically enough will end up hitting the pay packets of those workers that we weren't going to cost them any more money. So
I mean, I suppose they've tried to soften the blow a little bit. The employee allowance that used to be 5,000 if you were eligible has gone to 10,500, and what they've also done is removed the upper level. So there used to be an upper level where if you paid more than 100k in NI, I believe you didn't get the employer's allowance.
They've removed that.
They removed that, but as you've said, to a really big employer, I'm not being funny, that extra 5,500, given what this potentially has cost, is not great.
I mean, obviously, planning points with regards to that, maybe for employers with smaller numbers, you might actually find that you're maybe slightly better off. That employer's allowance is really a crucial change. Maybe if we've got clients where they've got individual single director payrolls,
they obviously wouldn't normally be eligible, but it may be worth now that
thinking about bringing somebody else in, a spouse, a relative or something like that, maybe getting them on the payroll, giving them a small wage so that now you can benefit from that.
Yeah, I mean,
10.5.
Thinking about that, obviously you've only got to bring them on to 5,000 now. Previously you would have had to pay them the sort of 9k to get over the allowance. Now you've only got to pay them 5. So maybe, for a child at a Christmas job, something like that might just tip you over into being able to qualify for that employer allowance. The other thing I think about as well, I think, is salary sacrifice again will become. So this is obviously for things like pensions and things.
Pension contributions.
If people do that via salary sacrifice, obviously the employees do save the employees NI. Not as powerful as that was, obviously, given the previous government did reduce the employees NI a couple of times, but certainly now for employers. Salary sacrifice could be something that we could think about offering.
Most pension providers are quite happy to do that, and even those that do it through auto enrolment. So again, that's maybe something to think about.
I mean, it is a contractual thing, and obviously people have got contracts that have got to be changed. So you've got to remember to make sure you dot your I's and cross your T's on that, but it could be worth doing. I think the other thing to remember is if people employ apprentices and those apprentices are under 25, you don't pay any NI for. So again, it's probably worth just double checking you've got the right box ticked on your payroll software and that you've claimed that exemption, because that becomes even more valuable now.
And salary sacrifice, it can help in another couple of areas, cycle to work schemes, and also electric cars is still it's only electric cars that it works for, not hybrids or anything like that.
I think there was a bit of a wheeze that they've closed on electric cars, but genuine electric car salary sacrifice does work.
Yeah.
These loan to buy your car schemes they've closed down in this budget.
Exactly. But again, salary sacrifice, as Sarah mentioned, it doesn't work. It's not like we can say, oh, well, we'll put through somebody's medical insurance
or
gym membership
That's what I normally get
school
asked.
fees or something like that. We doesn't work there, and it doesn't work with normal company cars. It is very limited. But particularly, I would say that the pensions
it's
very useful because most people are on auto enrolment, and it's not too difficult to flip over. So that can be a powerful saving tool, can't it?
So what then, to continue now to minimum wage and living wage, they've also changed those. So
yeah, so again, another impact for employers. The national living wage is increasing quite a substantial amount. So for employees that are aged 21 and over, the rate goes from £11.44 to £12.21. That's from the 1st of April. And also there is an increase to the national minimum wage for employees between the age of 18 and 20. That's going from £8.60 an hour to £10 an hour. And then for those aged between 16 and 17, the increase is from £6.40 to £7.55. So a general increase across the board, which again,
combined with the
NI change, as I say, for larger employers, I think we've done some calculations. It can be quite a hefty impact, and even for those smaller employers as well, perhaps where they've got a lot of kind of student workforce, things like that.
Yeah, I think the hospitality particularly complained, haven't they, saying that they're sort of only just recovering from COVID, really still, and then they've been hit with these these changes.
So again, unfortunately, it is one of those things that obviously has to be complied with. Just thinking about that point, though, that we were talking about with salary sacrifice, again, employers have got to be careful with how those two interact. Basically, you can't allow somebody to sacrifice too much salary so that their earnings go below the national living wage or national minimum wage. So that has to be factored in when
I think quite complicated calculations that people need.
But it's something that we can help with. As I say, we're very in favour of the rules. We can help guide you through, perhaps do exercises to calculate what the impacts are going to be, and also how a salary sacrifice could work for you and your business.
Now, you mentioned electric cars. What about other cars and the benefits in kind on those?
Yeah, so we've had a bit of a kind of a freeze, as it were, on company car rates. That freeze is lifting; it's starting to go up. So we've got some clarity of what's going to happen from 28 to 29 tax years onwards. I think the biggest thing is that the upper rates at the moment are capped at 37%. It will go up to 38% in 28-29 and 39% in 29-2030.
When we say percent, that's a percent of
percentage of the list price and when it was new, not what you bought for it.
These are the things get caught out by. It is actually the list price when it's new, isn't it?
Electric cars are going to start seeing an increase in their percentage. At the moment, they're at 2%. They're going to rise by 2%, I think, every year until they hit 9% by the year 29.
Still, though, I would say if you're going to have a company car, electric would be the way to go if you don't suffer from range anxiety.
That's it, yeah. Still a lot better than standard vehicles.
And then when we talk about cars, double cab pickups.
Yeah, so if you've seen our corporation tax video on the budget, you'll have seen us mention about double cab pickups. Again, this is impacted on benefit in kind. So double cab pickups are now going to be treated from the 1st of April as cars, not vans. Now, as you can imagine, double cab pickups are not the most environmentally friendly, so they're going to have quite high CO2 emissions, which means the percentage is going to be quite high. And again, it's on the list price. So that is going to have quite a big impact on particularly construction companies, farmers. Farmers have been impacted quite heavily by the budget. There are transitional rules, though. So a bit similar to the way it works for capital allowances, rather. If you've already got a double cab pickup, then nothing will change on the in the new tax year. It will still be benefit in kind as a van until the earlier of three things. Either if you're leasing the vehicle when the lease runs out, or when you sell the vehicle, or the 5th of April 2029. So it doesn't mean you've all got to start selling your double cab pickups immediately. In fact, you probably want to hang on to them at least until the 5th of April 2029. If you purchase a new double cab pickup, again, depending on when it's going to be delivered and whether you've paid a deposit, it could be that you order one, say on the 1st of January, pay a deposit. It's not delivered until July, which would be after the 5th of April, but you'll still be benefit in kinded under the current van rules. So there is still a window for people to buy these cars or buy these vehicles and still benefit from the current rates. But obviously know that by the 5th of April 2029,
that's all going to change.
That will all stop. They will all become and taxable as cars.
Interesting to see what it does to the price of them as people start to
get
out of them.
Yeah.
I think while we're talking about benefits in kind, shall we talk about payrolling of benefits in kind? So this was something that I think has been announced for a while, and the budget just confirmed some of the rules in relation to that. So from April 26, payrolling, which means rather than waiting till the end of the year and completing a P11D, your benefits in kind
will be reported on the payslip.
On a payslip.
And taxed as they go.
And taxed as they go.
Which I think, I actually think that will be eventually, let's say eventually, a very good thing, because as we see at the moment, somebody has, for example, private medical insurance, a premium of say £1,500 this year. It goes on the P11D at the end of the year. If it's the first year they've had it, well, they've not paid any tax on that so far. They then have a clawback in next year. Plus, they have to pay the tax for the next year. But guess what? Your premium next year is now £1,750, but you're only paying it on 15. You're always on a catch-up. So at least if they're doing this in a more real-time basis, it will start to smooth that out. People aren't going to get nasty surprises and things like that.
No, I think a couple of benefits are staying on the old rules, aren't they? So P11Ds will still exist for beneficial loans and living accommodation.
Yeah.
But generally, I think they're going to go to be payrolled. Also for living accommodation and loans, the official rates.
Yeah. So the way that the benefit is actually calculated. So if you've got a loan, an employee loan, for example, or a director's loan account that's owing back to a company, once it goes over £10,000, it becomes fully chargeable from the minute it went overdrawn to whatever it is now. But the way that the benefit is calculated is based on a percentage. So it's based on the average balance of the overdrawn account for the tax year. That figure is then multiplied by a percentage, which is currently 2.25%. And it's that number, that effective interest, as it were, that's what you pay the tax on.
Yeah. So your benefit in kind isn't the loan itself, it's the interest you haven't paid because you had that loan. But that loan interest now is going to be reviewed quarterly. So previously it was set for a year and you sort of knew where you stood. Now they've got the ability to change it every quarter.
Yeah. Whether it will be, I say 2.25% at the moment is a lot lower than the base rate. Whether that will mean that they'll start to move it up to base rate or not, we don't know yet. That's not been publicised yet.
So thank you very much for listening to this webinar on the changes for employers. I say quite significant this time. So if you've got questions, obviously get in touch and look out for the remainder of our videos.
Thanks very much.